And now I would like to introduce Professor Nouriel Roubini. He is a world-known economist. ובריאיון, you can come, Professor Roubini. Thank you. ובריאיון אחד על אחד, הוא ישתף אותנו בהערכותיו על הכלכלה הגלובלית והשלכותיה על ישראל. את הריאיון יקיים מתן חודורוב, פרשן כלכלי בכיר בחדשות 13.
Thank you very much for the introduction. Good morning to you all. Good morning, Professor Roubini.
Great being here.
This is great privilege to have you here, especially such a decisive week of national budget approval. And before we go internationally, you've probably noticed the headlines describing $1 billion transfers to the ultra-Hasidic Orthodox sector, what we call Haredim, without demanding basic studies like math and science in return. What is your observation as international economist, expert, regarding such policy of funding private education, ensuring national interest?
Yeah, no, I was pointing out that Israel has traditionally had a dual labor market with part of the population being highly skilled, productive and so on, and unfortunately part of the population, including the one of the ultra-Orthodox, not having traditional kind of a scientific education. Those divisions remain, even if there is some part of the Haredi community that now joins the labor force. But I would say that, of course, any transfer payments that are increasing the fiscal deficits that go just to traditional religious education without any change are going to, over time, have fiscal consequences and, of course, increase the gap between those that are high-skilled and those that are low-skilled within the country. So that's not something that, of course, it's positive for the country.
Yeah, that's extremely important because by 2065, 1 out of 3 Israelis will be Haredi, according to official estimations by the Central Bureau of Statistics. And therefore, the question is crucial. How can we further act to combine this partly productive minority into our labor market? What would be the wise policy to adopt in order to reach that target?
Well, it's clear that the situation in which eventually 30% plus of the population doesn't have skills, doesn't actively participate in the army, in the labor market, is not something that is economically or fiscally sustainable. Part of it has been, of course, driven, this demographic, by the fact that there are significant transfer payment and subsidies that increase fertility rates. You know, if those were to be changed, of course, people will have less children. And I think that within even that community, there is probably a realization that being completely cut off from the labor market doesn't make sense. Probably lots of the younger people want to have economic opportunity, and the hope is that some of these people realize that their own economic fortune depends on getting education, being able to participate in labor markets, and being productive member of society. Otherwise, socially, politically, economically, and fiscally, this becomes a situation that is totally unsustainable over time.
So with all due respect to Israel, the US currently faces a huge crisis of debt ceiling, which has to be raised by a consensus of both Republicans and Democrats. Otherwise, they will go down the road at the slippery slope. How do you estimate the chances that the country will actually slip into insolvency?
Well, I think that eventually the U.S. is going to reach a political agreement on the debt ceiling. Often you get up to midnight and you are reaching an agreement. So I don't think that there'll be a technical default that will be disastrous for the treasury markets. I think that the broader question, however, is that U.S., like in most of the world, live in a world in which there is too much debt, too much private debt, too much public debt. If you look at the share of private and public debt as a share of GDP, you know, it used to be 100% of GDP in the 1970s. By 2000 was 200%. Last year, the global number was 350. In advanced economies, the ratio is 420 and rising. In China is 330. Typical emerging market, 250. Now, until 3 years ago, debt ratios were high, but debt servicing ratios were low because we had zero policy rates, negative policy rates in Japan and Europe.
Yeah, and now the huge debts meet the higher interest rate, which makes it much more complicated.
Yeah, so today we are in a world in which, because inflation has been rising, as Rafi made it clear in his great presentation, central banks are raising policy rates, short rates are going higher, long-term bond yields are going higher, and therefore in the private sector, depending on the country, is indebtedness of the household sector, or the business and the corporate sector, or some parts of the financial sector in some countries. The government, of course, has too much debt, and some countries have, just as a country, too much foreign debt. So in a world in which interest rates are rising on the short and long end, eventually these debts are going to become unsustainable. The IMF and the World Bank already expected about 60 poorer frontier economy are going to have debt servicing problems. So one of my concerns is, as I present in my new book, Mega Threat, is we're going to be facing in the next decade what I call the mother of all debt crisis, because debt ratios are becoming across the board unsustainable.
Something like in 2008, which has also begun by a debt crisis?
Well, you know, the difference, I think, that makes it in some sense worse is that in 2008 we had too much debt, household debt, mortgage debt, banks debt, and we had a debt crisis. But because the shock was a shock to aggregate demand and a credit crunch, we had deflation coming into that crisis. So central banks could massively ease monetary policy, fiscal policy, credit easing to try to prevent a Great Recession from becoming a Great Depression. The difference today is that we're facing negative aggregate supply shocks that led to less economic growth and higher inflation, the impact of the COVID crisis, the impact of the brutal Russian invasion of Ukraine on commodity prices, until recently zero COVID policy of China. So we are going in a world in which there is less growth, there is higher inflation, and therefore we're entering a situation where central banks have to tighten monetary policy. We have to have a contraction of credit. We need fiscal retrenchment. So in some sense, we have the worst of the 1970s when we had negative aggregate supply shocks that were stagflationary. As you remember, the 73 oil shock and the 79. And we have the worst of the period after the global GFC, because we have now debt ratios that are much higher than even after the GFC. So we are in the front of what I call a great stagflationary and debt crisis at the same time.
Yeah, sounds
the worst
like
of the 70s and the worst of the post-GFC
Sounds
period.
like a lose-lose situation. So let's talk a little bit about prices and cost of living. Do you expect an end to the global inflation era anytime soon? We've seen Professor Melnik's figures just now, and he claimed that this is too early to call the end of the inflation era.
Yeah, you know, my view is that you have to go beyond the short run and look at the medium, long-term structural factors that are driving inflation. Of course, in the short run, the rise in inflation last couple of years was driven both by bad policy and bad luck. Bad policy being excessively loose monetary, fiscal, and credit easing, given the size of the COVID shock, and on the side of the bad luck, negative aggregate supply shocks that reduce production, like COVID, the zero COVID policy, and the shock coming on commodities from the Russian invasion of Ukraine. However, even if these shocks were to be phased out, in my book I identify 10 more medium-term to long-term negative aggregate supply shocks that reduce economic growth, increase cost of production, and with loose monetary and fiscal policy are going to lead to inflation and stagflation. I don't have time to go into detail of them right now, but one, of course, is deglobalization and protectionism. The second one is reshoring of manufacturing or friendshoring as opposed to offshoring. The third one is aging of population, both in advanced economies and emerging markets like China, Russia, Korea, Taiwan. Fourth, restriction to migration from south to north, from poor to rich, that kept the lead on wage growth in the past, but now are restricting the supply of labor. Five, we have this geopolitical depression that is leading now to cold and hot wars that are going to fragment the global economy, decouple the risk, lead to a balkanization of global supply chains. Additionally, we have a global climate change that has impacts both on energy prices and food prices. We're going to have a recurrent pandemic. Unfortunately, COVID-19 is not going to be the last one. It's going to be also stagflationary. We have cyber warfare that's going to reduce growth and increase cost of production.
These are all causations, but what makes this inflation so sticky? How come it only partly responds to the interest rate increasing adopted by almost all Western central banks? Why doesn't it work?
If the shocks to inflation was coming from aggregate demand, reducing aggregate demand with higher interest rates is going to help you. If instead you have these negative aggregate supply shocks that reduce growth and increase inflation, first of all, it's much harder to fight inflation. Two, you get into a dilemma, because if you fight inflation where growth is lower, you have a risk of a hard landing. And three, in a world in which there is too much private and public debt, not only you have a dilemma, but you have a trilemma, because central banks have to achieve price stability, growth stability, avoid a hard landing, and financial stability. But as you raise interest rates, the risk of a hard landing is bigger. As you raise interest rates, the risk of debt crisis become higher. And I think that central banks are going to soon this year reach a point in which on one side they say, we cannot raise interest rates more because we'll have a hard landing, we'll have financial stresses for the banks and for the debt. But if interest rates are not high enough...
And we also damage the growth, because we currently face dimension, not to say recession, you know.
Well, you have three goals: price stability, growth stability, and financial stability, and you have only one policy instrument, that is the policy rate. And it becomes, in my view, mission impossible. So either you accept inflation to be higher, or if you fight inflation all the way, you're going to go into a recession and a financial crisis. And I think between the two, actually, central banks are going to blink, they're going to wimp out. They're not going to be able to fight inflation because the economic and financial consequences of it are going to be too costly, and therefore we're going to live in a world in which there is going to be much higher inflation.
Meanwhile, we see the banking system becomes super profitable, at least here in Israel, with higher funding incomes, while the vast majority of their clients, from household to small businesses and mortgage payers, they all kind of suffer. Do you see it as a stable equilibrium, or some additional steps will have to be taken in order to somehow divide the wealth between the banking and the clients?
Well, you know, what's happening also in Israel is that there was a rise in inflation. You had the necessity for the central bank to raise policy rate to fight inflation. That's leading to a slowdown of economic growth. Growth is also slowing down because global growth is slowing down. Three, you have also the fact that, you know, last year the tech bubble globally went bursting, and therefore, especially those weaker firms that had startups with no real business plan had a massive correction. Some of them went up, some of them, their valuation have fallen. And now, on top of everything else, of course, these political trouble within Israel with the tension on the judicial reforms are leading to policy uncertainty. Foreign investment in the country is sharply slowing down. Even the local tech investors are spending less, and that's going to also slow down, you know, economic activity. So you are in a situation that in many ways is fragile because you need price stability, you have to fight inflation, growth is slowing down, and you had an economy where home prices were high, lots of people in the private sector, given slow growth of income, are also borrowing a lot, personal loans of various sorts. Parts of the corporate sector are indebted. For now, the banks are doing fine, but you know, if you had, unquote, a hard landing of the economy, duration risk is going to become credit risk, and therefore even financial institutions could be under some kind of stress. So the same trilemma
we've seen
that you face in Europe,
stress.
US, you're facing it in some extent also in Israel.
Yeah, especially at the SVB bank, if I remember correctly. So the Fed had to bail out, in a way, some of the minor banks in the US. Do you see this as a one-time event, or will it be a phenomenon extending where the Fed will have to bail out more financial institutions in order to avoid a wider economic shock?
Well, there is a set of banks in the US that are regional banks that have a narrow deposit base, that a lot of uninsured deposits, that invested a lot in long-term bonds whose value has fallen because interest rates have been rising. And as interest rates were going higher and the deposit rates were low, were subject to a run, and many of them have gone bust. I think that the key issue for the banks is going to be until now, the concerns for the banks in US and Europe was what people call duration risk. If you hold long-term bonds, yields are going higher, prices falling, you have unrealized losses. But if the economy is going to weaken, if we're going to go into a hard landing, duration risk is going to become solvency risk, because in a situation in which there is a recession, households cannot pay mortgages, they cannot pay credit card, personal loans, they leverage businesses in the private sector become insolvent because they have too much debt, and so on. So you have fragility in the private sector, and if the non-performing loans rise, then you have the problems of the household and the corporates spilling over to the banks, and then you get credit risk for the banks. So the trigger point for the bank from now on is not going to be the liquidity or the duration risk, but it's going to become increasingly the solvency risk, if there is going to be a hard landing of the economy.
You've mentioned the judicial reform here in Israel, from the way that justices are being elected to the authority to cancel anti-human rights legislations. Is there any connection that you can point out between the politicization of the legal system and the struggle for democracy and the economic outcomes of Israel for years to come?
Well, you know, historically, we know that in countries in which there is not good rule of law, there is political and policy uncertainty, reforms that are required for increasing potential growth do not occur, and those kind of uncertainties lead to less foreign direct investment, lead to a depression of the sentiment of the private sector, and then they weaken investment in the private sector, and they weaken economic growth. And if you add to that one then fiscal policy that become increasingly excessive and loose eventually, that leads also to macroeconomic fragility. I mean, in Israel, we're not yet there, but examples like, for example, nearby of extreme cases of like Turkey, where on one side there's been a massive politicization of the economy, there has been massive fiscal stimulus, quasi-fiscal stimulus, credit easing, inflation getting out of control, FDI collapsing, and so on. They lead to significant, you know, Turkey is going to be on the verge of a real financial crisis, and so on.
And so we have special sensitivity to high-tech. Do you see room to concern that high-tech investments driving the entire Israeli economy will continue dropping below the international average rate of dropping, as a direct result of such legal uncertainty follow the judicial reform?
You know, we all know that the tech sector is a key element of the Israeli economy. Half of the exports come from the tech sector. You know, I spoke actually with a number of venture capitalist investors who are Israeli-based. They tell me that the amount of money is coming from abroad has gone down to a trickle right now. Because of the political uncertainties, foreign investors are worried about putting money into VC funds, so that money that was supporting literally dozens of billions of dollars per year now has become a fraction, 20% of what it was about a year ago. And I would say that, you know, even speaking with local tech investors, they're saying these types of uncertainty is not positive for us. Some of them say, you know, most of my assets are intangible. I could just pack and move to Greece or, you know, Cyprus or anywhere else in a situation in which things become really unstable. So I think that that definitely is a source of policy, and political uncertainty is having a weakening effect on business sector, on economic activity, and on economic growth. So those weaker expectation of growth for this year are partly driven by this policy uncertainty.
Do you think that senior leaders like Prime Minister Netanyahu cannot see this professionally, or maybe they are aware of other political considerations, short-term considerations, rather than the beneficiary of the economy for the long term?
Well, you know, many Israeli economists and business people have written petitions making the argument that these types of uncertainty is going to be bad for economic growth. I think that some member of that coalition may not even care about economic growth as long as there is, you know, transfer payment to their own social groups and so on. Eventually, however, you know, the taxes on the productive side of the economy, starting with the tech sector, are those who are financing the spending and the transfer payments to other parts of the population. I hope that, you know, that these economic arguments of why this is going to be very dangerous and bad for the Israeli economy are going to be, you know, increasingly understood. There is pressure from the markets in terms of market discipline, could have impacts on the currency value, on interest rates. There's pressure coming from the rating agency that might essentially downgrade eventually Israel. And the weakness of economic activity may also lead to a pressure to be more reasonable on these issues.
Well, we are almost out of time. We are actually out of time, but I'm not sure that our audience is aware of your Jewish and Israeli origins, right? You're an American Jew, and you also have a family here in Israel, which brings you a lot to our region, to our neighborhood.
Yeah, no, my parents and my sister live in Israel nearby, so I come 3 or 4 times a year. It's always a great pleasure to come to Israel. It's a wonderful country that I love very much, and I hope for the best for Israel and for its economic, social, and political future.
And we are very happy to have you here, Professor Nouriel Roubini. Thank you very much for that introduction.
Thank you for having me. Thank you.